Welcome to Prime Finance. In today's video, we explain how to start in cryptocurrencies. A complete guide for beginners. Do you want to start in the world of cryptocurrencies but don't know where to begin? In this video, I'll give you a complete beginner's guide. You'll learn what cryptocurrencies are, how they work, the risks involved, and key tips for investing safely. Don't forget to subscribe and turn on notifications for more videos about finance. Today we're talking about a topic that is revolutionizing the digital economy: cryptocurrencies. You've probably heard of Bitcoin, Ethereum, or Dogecoin, but do you really know how they work? Is it a good investment or just a bubble? If you're a beginner and don't want to make costly mistakes, stay until the end because I'll give you the best tips to get started safely. What are cryptocurrencies? Cryptocurrencies are digital currencies that use cryptography to ensure secure transactions. Unlike traditional money, they are not issued by any government and do not rely on central banks. They were created to decentralize the economy, allowing transactions without intermediaries. The first and most famous is Bitcoin, launched in the year 2009 by a mysterious developer under the pseudonym Satoshi Nakamoto. Since then, thousands of cryptocurrencies have emerged, each with different characteristics and purposes. Some of the most popular ones include Bitcoin, BTC, considered digital gold, used as a store of value. Ethereum, ETH, not just a cryptocurrency but also a platform for developing smart contracts. Binance Coin, BNB, used within the Binance ecosystem to reduce transaction fees. Ripple, XRP, designed for fast, low-cost international payments. Cardano, ADA, offers improvements in scalability and sustainability compared to Ethereum. But how do these digital currencies actually work? How do cryptocurrencies work? To understand them, we need to learn about the technology behind them: blockchain. Blockchain is a decentralized digital ledger that securely and transparently records all transactions. Imagine a public Excel sheet where every transaction is verified by multiple users worldwide instead of relying on a single bank or institution. Mining and validation. Some cryptocurrencies, like Bitcoin, require a process called mining, where high-powered computers solve complex mathematical equations to validate transactions and add them to the blockchain. Proof of work, POW, versus proof of stake, POS. POW, proof of work, requires large amounts of energy and specialized hardware to mine. Example, Bitcoin. POS, proof of stake, based on the number of coins you own and lock up to validate transactions. Example, Ethereum, after the upgrade to Ethereum 2.0. Now that we understand how they work, let's see how you can start investing in cryptocurrencies. How to start with cryptocurrencies. Step by step. If you want to enter this world, follow these key steps. Step 1. Research and educate yourself. Before investing, it's crucial to learn. Don't be swayed by promises of easy money. Some recommended sources include books, The Bitcoin Standard by Sefedian Amos. Online courses, platforms like Udemy or Binance Academy. Communities, Reddit, Twitter, and Telegram groups about crypto. Step 2. Choose a reliable exchange. An exchange is a platform where you can buy and sell cryptocurrencies. Some of the most secure and popular ones are Binance, wide variety of cryptos and low fees. Coinbase, easy to use, ideal for beginners. Kraken, known for its security. Step 3. Create your digital wallet. There are two types of wallets. Hot wallets, online like Trust Wallet or MetaMask. Convenient but vulnerable to hacks. Cold wallets, physical like Ledger or Trezor. More secure because they store cryptos offline. Step 4. Make your first purchase. Once you have an exchange account and a wallet, you can buy cryptocurrencies using fiat money, euros, dollars, pesos. It's best to start with small amounts until you fully understand the market. Step 5. Security and protection. Never share your private keys. Enable two-factor authentication, 2FA, on all your accounts. Be wary of offers that seem too good to be true. Common mistakes to avoid. Investing without research. Don't follow trends without understanding the risks. Putting all your savings into crypto, it's a volatile market. Never invest more than you can afford to lose. Falling for scams. Watch out for pyramid schemes or promises of guaranteed profits. Cryptocurrencies offer an incredible opportunity to invest and revolutionize the economy, but they also come with risks. With proper education and safe strategies, you can take advantage of their potential without falling into traps. Leave a comment if you have already invested in cryptocurrencies and share your experience. Now, we'll go deeper into advanced strategies that will help you make smarter decisions. We'll talk about trading versus long-term holding, reading charts, earning passive income, and risk management. Let's get started. Trading versus holding. Which one is better? There are two main investment approaches in the cryptocurrency market. Holding, HODL strategy. This means buying cryptocurrencies and holding them for years, expecting their value to increase over time. Trading. This involves buying and selling cryptocurrencies over short periods to take advantage of price fluctuations. Holding strategy, HODL. Best for long-term investors who believe in the future of cryptocurrencies. Pros. Less stress and time commitment. Potential for huge gains if held for years. Cons. Market crashes can take years to recover from. Requires patience and strong belief in crypto's future. Trading strategy. Best for those who want to actively profit from daily price movements. Pros. Opportunity for quick profits. Can take advantage of both rising and falling markets. Cons. High risk if you don't know how to analyze charts. Requires constant monitoring and knowledge of technical analysis. If you prefer less risk and long-term gains, hodling is the safer option. But if you enjoy fast-paced action, trading might be for you. How to read crypto charts. If you want to trade successfully, you need to understand market trends and price movements. The most important chart type is the candlestick chart, which shows 4 key price points. Open price, the price when the period, hour, day, etc. started. Close price, the price when the period ended. High price, the highest point during the period. Low price, the lowest point during the period. Key indicators for crypto trading. Moving averages, MA helps identify trends over time. Relative strength index, RSI measures if a crypto is overbought, high price, or oversold, low price. Support and resistance levels, price points where a cryptocurrency tends to bounce up or down. Understanding these indicators will help you avoid panic selling and make better decisions. How to generate passive income with cryptocurrencies. If you don't want to actively trade, you can earn passive income in different ways. 1. Staking. What it is: locking up your cryptocurrencies to support a blockchain network in exchange for rewards. Best for coins that use proof of stake, POS, like Ethereum or Cardano. Potential earnings, between 5 to 20% annually, depending on the coin. 2. Crypto lending. What it is: lending your crypto to other users or institutions in exchange for interest. Platforms: Binance Earn, Celsius, BlockFi. Potential earnings, between 4 to 12% annually. 3. Yield farming. What it is: providing liquidity to decentralized finance, DeFi, platforms and earning rewards. Platforms: Uniswap, PancakeSwap, Aave. Risk level, higher, but potential rewards are greater. Risk management strategies. The cryptocurrency market is extremely volatile, so managing risks is crucial. The never invest more than you can afford to lose rule. Only invest money that won't affect your daily life if lost. Portfolio diversification. Don't put all your money into a single cryptocurrency. A good portfolio includes 50% Bitcoin, BTC, safe store of value. 25% Ethereum, ETH, strong blockchain platform. 15% altcoins, Cardano, Solana, etc. 10% stablecoins, USDT, USDC, to protect against volatility. 3. Stop loss and take profit orders. Stop loss automatically sells your crypto if the price drops too much, limiting your losses. Take profit automatically sells when your target profit is reached, locking in gains. Using these tools prevents emotional trading and helps you stick to a solid strategy. Cryptocurrencies can be a great investment, but they also carry risks. The key to success is education, risk management, and having a solid strategy. Let's recap what we learned today. Trading versus hodling: choose the strategy that suits you best. Reading charts helps you make smarter decisions. You can earn passive income through staking, lending, or yield farming. Always diversify your portfolio and set risk limits. If you found this guide helpful, smash that like button and subscribe for more crypto and finance content. See you in the next video. Bye.